Okay, welcome to the October 25th edition of the Fats, Fuels, and Oils webinar. This week, we're going to talk a bit about DCO, and then we'll go through sort of what's going on in vegetable oils, and then our usual kind of roundup of what's going on with margins and our forecast for credits. And we'll talk a little bit about the EPA EMTS data that came out last week, although I haven't been able to download the full data set. I don't know if anybody else is having problems with that website or if anybody else looks at that website. I know Bob Lane was having problems with it too. If anybody was able to download the full table of RIN generation, the one that sort of appears at the bottom of the screen, if you would send that to me, I would really, really appreciate it, because the way that our system is set up, there's a data scraper that needs that data formatted in a very specific way. And without that, I can't really update all of the data, but I was able to update the renewable diesel and biodiesel data. And so we can talk about that. Anyway, so I guess just generally over the past week, it's been kind of quiet, even though vegetable oils really took off and rallied. A lot of things were up 5 cents or more, and that's due in part to the dryness in Argentina, which we're creeping closer to the beginning of planting season. Obviously, it's still too early to impact yields in any significant way, but it is getting to the point where concerns about planting delays are starting to grow. Typically, Argentina starts planting their first soybean crop, which is the bigger of the two. It's about 3-to-1 or so, 75-25, basically for the first crop and the second crop. And they start to plant the first crop in the second week of November or so. So it's getting close to planting now. The planting window stretches through December, so it's a pretty long planning window. So even if the early planning is delayed a little bit, I still don't think that will be a big impact, but it is something I think that has contributed to the rally in veg oils. Also, concerns about the grain corridor out of Ukraine and the impact that could have on Ukrainian exports, and the attack on a sunflower oil storage facility also contributed to the strength in vegetable oil prices. I think that the attack on the storage facility, obviously that reduces that supply, but Ukraine has done an amazing job actually of shifting their exports. If you look at the routes that exports have taken, it shifted from sort of 96% by sea to about 50-50 land to sea. And so if the grain corridor closes, obviously that will have an impact on exports, but it's not like it will completely remove them. So I don't think it's like we go back to the concerns that we had before the start of the war, when people didn't know if Ukraine was going to be able to export anything. And in probably the most extreme case, or maybe not even the most extreme case, it probably just extends a trend that's already happening, which is Ukraine exports less sunflower products and more sunflower seed to Europe, and then Europe crushes them. Of course, there are concerns about electricity in Ukraine, and Ukrainian crushers have been asked to conserve electricity. There are also concerns about power in Europe, although not as significant as the concerns about the power in Ukraine. So I think that if that corridor closes, there's an impact on sunflower oil exports, and that will probably help support prices. Although I would also argue that I think you could also have a situation where maybe you replace some of those sunflower exports with exports out of canola exports out of Canada, particularly for China, which if you look at Chinese oil consumption, it was kind of down last year. We've got it growing a bit this year. If you reduce sunflower oil imports, you can probably offset most of that, maybe all of that, with canola oil imports from Canada. The key variable there really will be how much does the U.S. what is the U.S. demand for canola oil from Canada? If soybean oil demand for biofuel feedstock is really high, then we probably need more canola oil for the food industry, and that probably limits the amount of canola oil that's available to China for Chinese import. But Canadian exports are so heavily weighted to the U.S. It's a little bit more than 2 to 1. About 2 million tons go to the U.S. and about a little less than 1 million go to China. So even if the U.S. was a little bit larger or a little bit smaller, that would be a relatively much larger percentage of the imports that we're expecting for China this year. So while the market is, I say all that to say that while the market is concerned about what's going on with the grain corridor and the uncertainty about that will obviously continue to support prices, I think that at the end of the day, whatever the impacts are going to be, they're probably going to be a little bit less than the market is anticipating right now. And I don't think that that means that the market is anticipating, again, a complete shutoff of Ukrainian exports, because we've already seen that that's not going to happen. But I do think that there are other sources that can help offset some of the loss of those sunflower exports. And then, of course, if beyond that, if the South American crop is what it is supposed to be, obviously there's questions about Argentina, but so far Brazilian planting is going well, and the early season conditions seem supportive of the 150 million ton expectations. The last time that China really needed to replace sunflower oil because of the drought in Ukraine, they turned to Brazilian soybean oil imports. And so that's just another area that can help make up whatever loss we see out of Ukraine or the Black Sea region. Okay. Oh, in I guess the last point that I want to make on the rally is that given what we've seen in terms of the profitability of soybean oil as a feedstock and the profitability of biofuels just generally, in particular biodiesel, I think that that is also helping to support the market. And that is probably the one area, if that profitability continues, that's the one area that can probably have the most impact, at least on the soybean oil market. And of course, the soybean oil market then translates into all of the other feedstock markets and a lot of the other veg oil markets. So if we do have a situation where the data for soybean oil consumption in biofuel production remains stronger than expected through the end of 21-22 and in the beginning of 22-23, which is kind of what we're seeing, or the consumption that's going on right now, then I think that that it's going to be hard for the market to come back down. Now, it doesn't mean that I don't think that, at least right now, sort of the fair value for soybean oil is somewhere between 65 and 70 cents. That's a little bit of an increase from what I would have said 2 weeks ago, which is that it's basically around 65 cents. But it's not a huge shift in my outlook for prices. And as you'll see in a minute, generally I do expect prices to move lower from here after this rally is over. I think that as long as the South American growing season develops and supports normal crop development, then I think that that you probably see a slow move lower in soybean oil prices. All right. With that, let's talk a little bit about distillers corn oil. So this week I wrote about distillers corn oil, and that gave me a chance to kind of talk a little bit about ethanol production and where we are currently, where we expect to be next year, and the implications for DCO production and the DCO balance sheet, but also a little bit about the implications for the D4 and the D6 RINs. So ethanol production over the last 3 or 4 weeks has really started to accelerate. The weekly data shows that ethanol production has risen more than the 5-year average over the last several weeks. Now, it's coming from a lower level. And so even though we've seen week over week increases that are above the 5-year average, the total for the most recent week was still below last year's level. And we expect that probably continues. If you look at what the weekly data implies for October production, it implies a relatively large number. But if you look back at last year and what the weekly data implied, and then the monthly number that was ultimately reported, there was about a 4 million gallon difference between the monthly total implied by the weekly data and the total implied in the monthly total that the EIA ultimately reported. So there's probably something like that that's going to go on, and so it means that that our forecast for October ethanol production which is lower than what the weekly total would imply, is probably going to be someplace relatively close. And that means that DCO production has accelerated from the prior month, but it still kind of remains a little bit below last year. Now, I think the interesting part about DCO is not necessarily what's going to happen over the last month or what happened over the last month of the 2020-21-22 marketing year, but what's going to happen in 22-23. We basically have ethanol production steady, maybe a little bit lower, which implies steady, maybe a little bit lower DCO production. And of course, there is the growth in renewable diesel capacity, which should imply that biofuel feedstock demand will be up. Right now, we actually have, for DCO, we have biofuel feedstock coming down just a little bit year over year from 21-22 to 22-23. And we have non-biofuel up just a little bit, kind of offsetting each other. So I think that dynamic will be interesting, and it will be interesting to see whether ethanol production in 2023, in the calendar year 2023, will be where we expect it to be, which is, again, just a little bit below where we're expecting 2022 to finish. Right now, I think that if you look at, or at least recently, if you had looked at the spread between the 2023 vintage D4 and D6 RINs, the spread there is more narrow than the spread for the 2022 vintage. And at least right now, and of course, this is really early, we're not even into 2023 yet. But right now, I think what the market is expecting is that, yeah, ethanol production is going to remain steady or maybe a little bit lower, and the mandate is going to remain, I guess, at least above where ethanol production is, or domestic ethanol consumption is expected to be, and that's why you've got the more narrow spread for the 2023 vintage RINs than you do for 2022. For 2022, it looks like the situation probably has improved a little bit relative to what we've been thinking for a while. And that's why you've seen the spread between the 2022 vintage D4 and D6 widen out a little bit. Now it's started to creep back lower again, but not by that much. It really is still, and you'll see that when we go through the RIN forecast, it still is about where it has been, which is around 20, maybe a little bit less than 20. But I think that the early relatively narrow spread, or the more narrow spread for the 2023 RINs is kind of important. I think that it probably means that, at least for the moment, our forecast for 2023 is probably not wildly out of bounds, or it's not crazy to think that that ethanol production will be steady or maybe a little bit lower, especially given the fact that what we've seen in gasoline consumption since the summer, since prices really took off, that has been lower than expected. And so given that a lot of ethanol consumption is just driven by the need for an octane booster, that ethanol consumption probably would be down and or steady year over year. And so ethanol production would follow, and DCO production would follow, which just leaves us with that split between biofuel and non-biofuel. One of the things that I'm going through this week is my assumptions for non-biofuel, and trying to look at those not on a, well, partially on a commodity by commodity basis. I think it's probably relatively easy, and I think it's probably relatively easy to suggest that year over year you're going to see declines in non-biofuel for most or all of the biofuel feedstocks. It's been easy to do that, and that is kind of the broad approach that we've taken to our forecast, both in the short term and in the long term. In the longer term, basically, we try to figure out what we think the lowest level of non-biofuel consumption for each commodity is, and sort of taper our forecast down towards that. What we've seen is that for a couple of commodities, choice weight grease is probably the most prominent. We've actually seen kind of the opposite this past year, where biofuel usage has declined year over year and non-biofuel usage has risen. And so what I'm trying to do is go through and look at that stack of non-biofuel usage, both for biofuel feedstock commodities and also for commodities that we don't use in biofuel production, like palm oil. And if you look at that all together, it gives you a better sense of where things are. And if you look at it, the way that I kind of look at it is on a per capita basis. If you think about non-biofuel consumption as sort of food demand and feed demand, then it should grow at a rate that is approximately economic growth plus population growth. So maybe next year we have a slowdown in economic growth, and maybe that shrinks non-biofuel a little bit. I don't know that. I think there is I think if you look at that in the aggregate, there probably are offsets to that. So I don't know that necessarily means that you get big decreases, but I think that it's important to make sure that the bigger picture kind of fits, and then start to look at the individual commodities. And so as I go through that, it may be that DCO is a commodity that I have to change. And it's not like we have huge growth in non-biofuel demand for DCO next year. We've got it up, I think, 120 million pounds, which is, it goes from, I think, 705 to 825 or something like that. So it's kind of a big percentage of the DCO non-biofuel demand, but in terms of the overall supply of vegetable oils and fats and greases into the non-biofuel markets, it's not necessarily a huge percentage. So if we do end up changing DCO, I think it's going to be relatively easy to find other places to offset that decrease from our current forecast to one that would reflect more DCO consumption for biofuel feedstocks. As you can see from the price forecast, it looks like a lot of our price forecast where we've got prices kind of building into the end of the year as we anticipate growth in biomass-based diesel production, and then prices kind of go down a bit, and then you get another peak around June as the market builds in weather risk premium ahead of the US growing season. And then assuming that goes well, it starts to kind of decline again. Whether the shape of that curve shifts or not will depend a lot on exactly where we end up on ethanol production. And I think that ethanol production over the next couple of months will tell us a lot about what's going to happen in 2023. If we get sort of the typical kind of rise into the end of the year, although it's less pronounced in ethanol for a couple of reasons. But if we get that kind of typical little bump up, and it looks like ethanol is kind of following the normal path, then I think probably become more comfortable with the idea that year over year ethanol production doesn't change, year over year DCO production doesn't change that much. And if we don't, then I probably would look to maybe decrease our ethanol production forecast a little bit, and then obviously that would translate into lower DCO production forecast. Now, the one thing that I will say, the sort of a little bit of a wild card for DCO supply is improvements in technology for DCO recovery from ethanol production. And I think we've talked about this a little bit. It would have been a while ago, but there are technologies out there that allow improvements in DCO yields, essentially more recovery of DCO than ethanol producers currently produce, or than their current yields, I guess. And I've heard several different versions of this. The most extreme is that for not a huge amount of money, you can almost double the DCO yield. Again, I think that's probably one end of the spectrum. I think another end of the spectrum is sort of incremental improvements in the average yield for the industry. And we have that, excuse me, we have that built in to our forecast, but not for next year. I think we started either the year after next or the following year, and then we start to slowly ramp up DCO yields, but not to the level that we see, not doubling them over the next 5 years or something. Now, of course, I think if we see DCO prices really low relative to other commodities, I think we would need to revisit that. We don't get, obviously, DCO production numbers from USDA, so we kind of have to we kind of estimate them on our own, and we use price as a gauge of whether we think that the numbers that we have in terms of supply and demand balance sort of make sense. So if we started to see a situation where DCO biofuel use started to ramp up and DCO prices were holding steady or even moving lower, I think I would probably revisit those yield projections. One last thing, I guess, one more last thing on DCO supply and ethanol production will be, and I don't think that this is going to be a huge part of next year's story, but it's going to start to be a more significant part of the ethanol and DCO story over the next 4 or 5 years. And that is the switch in ethanol capacity from producing ethanol to producing jet fuel. There have been some major announcements about that shift. One of the big crushers has announced that they are going to take a pretty substantial portion of their ethanol production capacity and convert it to sustainable aviation fuel capacity. That would end up taking, I believe, a significant amount of DCO out of the market. And then so if that happens, again, it's something that we're going to have to sort of incorporate as we get a better sense of when it's going to come online, how much capacity there's actually going to be there, and in the real impact on DCO production. I think we're relatively early in the sustainable aviation fuel story. And so at this moment, we don't have substantial shifts in ethanol capacity to sustainable aviation fuel capacity. But over the last couple of times that I've done the long-term forecasts, there have been more facilities that sort of pop up under that pop up with sustainable aviation fuel capacity that were ethanol plants. And so if we get more of those, or as we get more of those, we will start to incorporate that more into our DCO forecast and our ethanol forecast, obviously. All right, let's move on to vegetable oils. Okay, so we talked a lot about sort of why I think soybean oil prices have rallied. As you can see, our forecast for soybean oil is kind of maybe a little bit of peak here and then kind of pretty much straight down. We don't really even have a boost in June for the typical sort of seasonal weather premium that gets added into the market. And that's due in part to the fact that if we do get the South American crop, you probably see soybean prices go down and probably drop down below 13, maybe even further than that. As soybean prices fall off, it becomes more difficult to have soybean oil prices at 70 cents. And so a lot of what's driving that decline in soybean oil prices is the assumption that we do get a really big South American crop, not just sort of the last couple of years obviously have been impacted by the drought, and this year what people are projecting is not just sort of a recovery to pre-drought levels, but an expansion in acreage in Brazil that would add a significant amount, 20 million tons to the Brazilian crop, or 25 million tons-ish to the Brazilian crop. And in Argentina, more of a recovery to pre-drought levels, but a 50 million ton crop in Argentina, so 200 million tons of production out of Brazil and Argentina. And you can add another, I don't know, 10, 15 million maybe in Paraguay. I haven't looked at my Paraguay numbers in a while, but a big crop nevertheless. And if that happens, of course, U.S. ending stocks are still projected to remain relatively tight, so that will provide some support for soybean prices, but it will weigh on soybean prices. And I think that, again, it's pretty easy to predict that soybean prices fall below 13, whether they fall below 12 or 11, go back down to 10. will depend a bit on the size of the crop, and will also depend a bit on U.S. consumption and what's going on with crush demand and export demand, and how tight U.S. ending stocks actually end up in 22-23. If we're still around 200 million bushels or 225 million bushels, I think that probably limits the downside, but it probably limits it to 12 instead of something lower. I think if you were able to, if something happened and all of a sudden 22-23 carryouts started to, or carryout expectations started to be 400 million bushels instead of 200 million bushels, then I think you probably could, and South American production is what it is, I think then you could start to make an argument that maybe you get soybean prices back down to 11 or even 10. But right now, I would say that that below 13 is really easy. 12 right now feels like an easy floor, and we'll kind of see how the South American growing season goes. But as those prices fall, it's going to have an impact on soybean oil prices. Again, of course, if renewable diesel producers just grow, if the renewable diesel industry just grows capacity like mad, and feedstock consumption goes way up, then you probably have soybean oil prices that are at the upper end of whatever the range is that's implied by soybean prices. And if you sort of look at a very long-term scatter plot of soybean oil prices versus soybean prices, there's a definite range. And in the last year or two, I guess 2 years really, there's a little clump that is outside or at the very top of that range anyway. And that's probably the new relationship between soybean oil and soybeans. But it doesn't mean that the base relationship is broke. It doesn't mean that that line, whatever the line of best fit through the new range is, that doesn't extend down as soybean prices go down. So I think that's what's going to happen with soybean oil prices, and that'll have knock-on effects on other things. It will also have implications for RIN prices and the profitability of biofuel production going forward. Outside of what's going on in soybean oil, I think the other interesting thing in veg oils, or there's probably two other interesting things, or probably a lot, but two at least that I'm focused on. One is that weekly Canadian crushing volumes really bounced back last week and were significantly higher than you would expect. The week over week change was significantly larger than you would expect for last week. And that drove our forecast for October crushing volumes up by 100,000 tons to, I think, like 820,000 tons or so. That number is in line with what we saw, not last year, obviously, but prior years. And I think maybe even a little bit below the record year 2021. The volume of canola crushing over the next couple of months will be really important and really instructive on how the rest of the year is going to go. And if we do get 800,000+ tons crushed in October, then I feel really good about the 10.35 million ton forecast we have for 22-23. But even at that, then to get to that number, you've got to have several months above 900,000 tons in there, and they come up pretty quickly after October. So, or at least a couple of them come up pretty quickly after October. So I think Canadian crush over the next couple of months will tell us a lot about what the marketing year total is going to be. And then I also think it's important because of the uncertainty about the grain corridor and the potential for Canadian canola oil to replace sunflower oil. if we start to see the crush sort of tailing off and Canadian canola oil production is not where we expect, then it starts to become harder to find enough suitable vegetable oil to substitute for sunflower oil. You don't necessarily substitute palm oil for sunflower oil. Those are kind of two ends of the spectrum. Not that palm oil is bad or anything, it's just it's used for different things than sunflower oil is, and it has a different price point than sunflower oil does. If they were readily substitutable, you would think that sunflower production worldwide would have gone to zero or relatively close to zero, but it doesn't, because it's preferred in the food industry in a lot of countries, and in the same way that canola oil is in the US. And so those two are relatively close and substitutable, and obviously you can stretch into soybean oil as well. But I think that if the Canadian crush is below our expectations and they do shut down the grain corridor, then it is going to be difficult to find enough supply to offset whatever decline in sunflower oil supplies will happen as a result of that. Back coming out of the pandemic, the decline in sunflower oil production due to the drought in Ukraine brought vegetable oil prices out of the pandemic lows, and were sort of the first, that shortage was the first leg higher in vegetable oil prices out of the pandemic. And then kind of the biofuel, the growth in biofuel demand took over after that. So it's not that, even though sunflower oil is not traded in volumes that are close to what we see for soybean oil, it still is a very critical component of the world vegetable oil supply, and replacing it will be something that I think is going to have a big impact on where vegetable oil prices go in 22-23. Replacing it or not needing to replace it, same kind of thing, just opposite direction. If Ukraine can maintain exports or increase exports, then we don't need to replace it, and then I think the market has some room to the downside for that. The other thing that I wanted to talk about before we switch to biofuels is just palm oil, and kind of the same trend is going on there. We still are seeing relatively weak palm oil export demand from Malaysia. Indonesia last week, or a representative of the Indonesian government said that they're considering extending the tax holiday on Indonesian palm oil exports through the end of the year. If that happens, it's going to be really tough for Malaysian palm oil exports to get any significant traction, and you probably build palm oil stocks, and the rally that we've seen in palm oil in this past week, probably it sort of stalled at the 4,200 ringgit level. That probably becomes the upper level of whatever the trading range is over the next year. And so I think that that palm oil prices in Malaysia really just depend almost solely on what the Indonesian government's policy is on exports. They still have the domestic market obligation program in place, but they continue to review that, and I think that probably will sort of slowly fade away. Again, if you look at production in Indonesia, supplies, even after exports, there's enough oil there to meet domestic demand, and I think that the program is there to ensure that they just don't export out all of the oil out of the domestic market and raise prices in the domestic market, or I guess maybe more accurately, that domestic prices don't rise to meet the world market prices. So I think it sticks around, but I think it probably maybe slowly tails off, just because I think even at current levels where they have to essentially provide about 11% of whatever they export to the domestic market, there's ample palm oil supplies in Indonesia to meet both export demand and domestic demand. And it's not like Indonesian exports are at record levels or something, that Indonesia has just taken all of this market share from Malaysia. Both countries and in the palm oil market in general is trying to find a new home for the palm oil exports that used to go to Europe, both for biofuel production and for other things. Europe has really tried to limit palm oil used in biofuel production, but you can see in the export data that there also is just sort of a shift away from palm oil imports in Europe beyond whatever the impact of the biofuel change is. Now, part of that new home is the US, and US feed industry is going to soak up some of that additional palm oil, especially if soybean oil demand for biofuel feedstock rises sharply. We're already seeing an increase in US imports of palm oil. It hasn't been really significant so far, and certainly not enough to offset whatever's lost in Europe, but it's a trend that is starting and is likely to continue until either soybean oil use as a feedstock declines for whatever reason, next generation feedstocks, that kind of thing. There's a change in biofuel policy or something. Until something kind of drastic like that happens, I think that trend in palm oil probably continues, and at least I think over the next year or so, it probably grows relatively slowly, but it may accelerate at some point, and then that will provide at least some offset for whatever the reduction in European demand has been. In the meantime, the spread, last week's rally with palm oil sort of stopping at 4,200, last week's rally meant that the spreads between soybean oil and palm oil started to move higher again. However, there's a big difference between sort of the December and January spreads than the rest of the spreads, the further out spreads. Those two really started to accelerate higher, not really started to accelerate higher. They started to move higher again. Whereas the deferred spreads are still kind of steady, still kind of in the mid 20 range, 25, 26, 24, somewhere in there, depending on the month. And we still think that those spreads will narrow. Now, thought that for a while, and they keep going the opposite way. So take that piece of advice with a really big grain of salt. I tend to think of the 30-cent level as sort of the upper level, but the market is kind of proving me wrong at the very current moment. So we'll kind of see, and maybe I will ultimately adjust, but as long as those deferred spreads remain flat and don't start to move higher, then I think that you start to see the spreads narrow. Now, there's every chance that as those contracts move closer to expiration, that then the spreads start to rally and move up towards the 30-cent level, or whatever the level was of the prior contract going off the board. But I'm still thinking they're gonna narrow. Okay. On to biodiesel, and I'll try and do this quickly. Every week I just go over. Okay, so for gross margins, we had sort of a return to what we have seen in a lot of weeks, which is Biodiesel margins went up, renewable diesel margins went down. It seems like they go in opposite directions quite frequently. The difference here was mostly due to a decline in renewable diesel prices from the weekly average, while biodiesel prices rose. Now, the weekly average reflects whatever the weekly average was, obviously. For renewable diesel, if you look at the daily prices, the price actually rose above $4. And we've got, through the end of the year, we've got the renewable diesel price remaining below $4. We'll see how long it stays above $4. But it may be in the next couple of weeks that I revise those projections higher, and then and above $4 if it looks like that's really going to stick. For biodiesel values without credits, we have kind of a similar forecast with prices in the sort of between $3.95 and $3.75 probably through the end of the year. But a similar thing has happened, and biodiesel prices have risen pretty sharply over the past couple of weeks, and it's a big change for biodiesel because they were stuck at the same level for quite a while, and we'll have to see how high they rise. But if they continue to rise, obviously I'm going to have to revise my forecast higher. And so the current forecast of margins kind of anticipates that fuel prices will be a little bit lower, but that's the risk. And then feedstock prices will generally be unchanged or maybe a little bit lower. I don't know what's going on at the end of the chart here. I was happy because I had fixed the big drop off that we saw for the beginning of 2023, and that was a situation where the fuel price forecast just kind of dropped off a cliff, which I think there's some reasons that you could say that, but the decline was too large, and so I narrowed that a bit, and that fixed that. But I don't know. I obviously don't expect prices to shoot up that much there. So there's something missing in the spreadsheet, and I will look into that after the webinar and try and get that fixed. All right. RIN price forecast for this week. We lowered it a little bit from what the model wanted to do, particularly for early 2023. We also lowered D4 just a little bit for the last little bit of 2022. The model really wanted to take D4 above 200. So I think that there's probably some upside price risk there, but I think we'll have to kind of, again, I think over the next couple of weeks, we probably will get a better handle on where energy prices are going to be, where the vegetable oil prices are going to be, and then of course that'll give us a good indication of what's going on with RIN prices. I would say that this forecast probably represents sort of the mindset from before the rally started in both feedstock prices and fuel prices. And if you look at, I wanted to show this chart this today. If you look at the forward spread for the HOBO spread going forward, if you look at that, that looks a little bit different than I thought, honestly. Either way, you've seen a big change in the HOBO spread from last week to this week, and this one may have changed since I looked at it again. But so I say that to say, kind of to follow up on the new trends in veg oil prices and fuel prices. Obviously that is having a significant impact on the HOBO spread, and over the next couple of weeks we'll kind of get a better sense of where all of that is going to go, or where we think all of that is going to go, and then we will try to adjust our forecast from there. What I don't particularly like doing when something like this happens is to just wildly adjust my forecast and then have prices go back down from down below $4 back to 375 or something, and then have to kind of reverse my forecast and just offset what I had done the week before. So it can take me a little bit longer to make changes when something like this happens, but it's because I like to make sure that whatever is happening, I think is going to continue to happen, or I think there's a good reason that it continues to happen. If there is an obvious reason that it's happening at the beginning, so if you have a war started, then it's easy to make those changes. But these kinds of changes that are a little bit more subtle, I tend to take just a little bit more time. Okay, so there's a rain forecast. LCFS credit price forecast, no change. We saw LCFS credit prices sort of bounce up back towards the 70 level over the past week, but then they started to come back down again. I think that, like we've seen before, I think that the bounce is probably a short-term pause, and still expect prices to kind of continue to move lower. And I'm going to stick with that until we really see that LCFS credit prices have put in a floor, or we get to the point where CARB makes changes to the LCFS program that will impact the value of the credits. All right, the last thing that I want to talk about is the EMTS data, just really quickly. So biodiesel based production basically came in, domestic biodiesel production basically came in exactly where we expected, or was within 1 million gallons of what we had predicted. So it's not likely that we're going to make any changes to our domestic biofuel or biodiesel production forecast based on this data. Imports were stronger than we expected, about 9 million gallons. And I do need to fill in the rest of the data before I can say for certain that I'm not going to make any changes. But for biodiesel, it seems more likely that I'm not going to make a change to the calendar year forecast just based on this data than that I would make a change to the forecast. For the import side of things, even though the imports were stronger than we expected, we had them sort of accelerating into the end of the year. And so all it did was kind of reduce some of that acceleration, at least at the moment. And we'll see what happens next month. And then if we're 9 million gallons below again, then we probably will raise our calendar year forecast. But right now, we just kind of offset it with reductions in the forward months. Renewable diesel, on the other hand, came in about almost 20 million gallons above where we had projected it. If you remember, we kind of last week I had the chart and it showed kind of steady renewable diesel production this month, and I think next month, and then kind of growing in the last 2 months of the year with the sort of seasonal increase that we see most years. Despite the increase, it wasn't record production, and so I'm going to change my renewable diesel forecast. Not exactly sure by how much, because even though capacity continues to grow, or at least the EPA continues to report increases in capacity, we still haven't, it's not like last year where when we saw basically a rise to a record level and then kind of production stayed close to that level, and then more capacity expansion, another rise, and then kind of stayed at that level. This is a little bit different, and I think the industry as a whole is doing a relatively good job of making the capacity expansion at a rate that doesn't necessarily drive the price of renewable diesel down through the floor. Renewable diesel has been underperforming biodiesel a little bit in the California market over the last couple of months, but now with this recent move higher, it's sort of back to where it has been traditionally, I think. And so it's not clear to me that this month is indicative of a huge change in our forward expectations. We had a build up already into the end of the year. And so right now, I think that I probably would offset the 20 million gallons with a reduction in the last 3 months of the year. But again, it will, excuse me, again, it will depend a little bit on what the other data for the other fuel categories looks like, and sort of what that implies for overall D4 production, D5 production, and how those then relate to the advanced mandate. All right, I think that is it for that, and we've got quite a few questions. Okay, so why would making jet fuel out of the ethanol market take DCO out of the market? You know, as I said that, I was thinking that that same thing. I think that I've been thinking that for a while, and I'm not sure that that I've ever known that specifically, honestly. I think somebody asked me at some point what the sort of comparative economics of SAF from ethanol and ethanol production with DCO were. And I think I started off with the assumption that that you don't get DCO when you make SAF production, and that may still be true. That's the way that I ran the economics for just sort of a back of the envelope calculation for that person, and I think I've kind of stuck with it since then. But I will make sure that I know next week, and I will talk about it at the beginning of next week's webinar, and let you know whether that is true, or whether that process does not allow the gathering of DCO. As I said, it didn't sort of, I thought the same thing in my head. Sorry. When do you expect the canola oil yields to normalize? They were still very low in this morning's report from StatsCan for September. So I haven't seen this morning's report yet, but it does seem to me like we probably are into the new crop crushing. So just given what the volumes look like for October, I would assume that we're into the new crop. If you remember the summer growing season, there was a period of kind of dry weather, and then there was some rainfall after that. That sounded really dumb, but the pod filling for canola oil or for canola seeds as in the oil content is similar to soybeans. And so if a lot of the crop filled pods kind of during the drier part of the summer, those couple of weeks when it was kind of really dry, then I think that you probably get a return to normal canola oil yields more quickly than obviously if it was wetter, if they were filling when it was wetter, because dry and warm tends to make more oil, and wet and cold tends to make less oil. I would be really surprised if in the October numbers, we don't get a really good sense of what the new crop oil yield will be. I would also be, I'm also maybe a little bit, or have been a little bit surprised. Last year was its own kind of thing, but I've also been a little bit surprised that that there hasn't been more of an effort to recover canola oil, I think, in the same way that we've seen in soybean oil yields. Now, I may be proven wrong on the soybean oil idea. And the last time that I said this, somebody sent me a very long letter explaining why they thought I was wrong. But I do believe that crushers can optimize for soybean oil yield. And if you look at soybean oil yields over the last 2 years, they've been at the very upper end of the historical range. I'm surprised that we haven't seen that, or I will be surprised if we don't see something similar in canola. And so even if the natural yield is a little bit lower, I would be really surprised if we don't see, given vegetable oils value and the high probability, well, the fact that we're going to get the approval of the RIN pathway for canola oil in renewable diesel production. And so all of that should support canola oil demand and prices, although I don't expect, a doubling of canola oil use in biofuel production because of the renewable diesel pathway, even though we have heard that that some biofuel producers are already starting to buy canola oil in anticipation of the approval. But given all of that, again, I would think that you would probably see canola oil yields rise a little bit relative to where they have been or relative to the historical band, given the weather conditions during pod filling, just based on the fact that it should be worth it for crushers to optimize a little bit for oil. Now, because canola is crushed more for oil than it is for meal, maybe they already do that, and maybe those improvements wouldn't be that great anyway. But I would expect that, again, I probably would expect that in October, you'll get a good sense of what the marketing year yield should be, or the October data will give some insight into what the marketing year oil yield will be. And I'll look at the Stats Canada data for September, and I will follow up with an email to you. What are your current expectations regarding the timeline and scope of potentially declining refining premium for soybean oil? That is the trickiest question of them all. So we're already seeing a little bit, we've already seen a decline in the refining margin for soybean oil. And you've seen a decline in RBD basis just generally, but part of that decline, or actually all of that decline, is come from a decline in the refining margin. The question is, if you think of RBD basis as the crude degummed basis plus the refining margin, there's going to be a shift, or I think obviously there's going to be a shift where crude degummed makes up a larger percentage of RBD basis and the refining margin makes up a smaller percentage of the RBD basis. And again, that's already started to happen. The question is, where does that stop? So does the refining margin go back down to the long-term average of 3 to 4 cents, and you have crude basis at call it 13 cents or something, or 12 cents, so you've got 15-cent RBD basis? Or does the crude basis stop at 9 cents or 10 cents, and so you've got a 12 to 13 cent RBD basis? I don't have a great sense of one, where the refining margin stops, or two, how quickly we get to whatever the new equilibrium is. I think part of that will depend a lot on the growth in demand from the biofuel industry, the growth in feedstock demand from the biofuel industry. So if crude degummed demand grows really rapidly because we go from 120 million gallons of production each month up to 200 million gallons each month by the end of the year, then I think crude basis probably jumps a lot. And that's not what we're projecting, but I think crude basis probably jumps a lot. And the refining margin might be a little bit stickier just because of so much of the crude supply is being taken off that there's not that much soybean oil left to refine. And so even though the RBD demand has gone down, the RBD demand relative to the available supply hasn't really changed that much. Conversely, if we get slower growth like we've kind of seen in renewable diesel production, and that crude demand kind of rises slowly, then I think we probably do move more quickly to the equilibrium. Well, we do obviously compared to the other extreme case, but I mean, I think in that case, you probably move to the equilibrium by the time that we get into the middle of next year, maybe. It's something that I've been trying to figure out, and it's something that I've been working on. And here's the things to kind of pay attention to try and figure out where we are in the process and when we will reach equilibrium. Obviously, the expansion in renewable diesel capacity, how much of that capacity has pre-treatment capabilities, which is the vast majority of it, and what the demand for crude degummed is, or what the demand for feedstocks are. So how much, not only what is the capacity, but what's capacity utilization, how much are they producing? On the other side, you've got the expansion in soybean crushing and soybean refining capacity. If you think about it, it probably makes sense that a lot of the expansion and refining capacity is not going to be RBD capacity. It's probably going to be crude degummed capacity only. And so the speed that comes on, and whether that is in balance with the expansion in renewable diesel capacity and the growth in demand for crude degummed, the intersection of all of that is going to tell you when we get to that equilibrium. And like I said, if somebody really put a gun to my head and said, hey, you've got to guess exactly when you think it's going to be, I would say probably by the time that we get to the middle of 2023, we'll be pretty close to where that is, assuming, again, sort of normal development. We don't go crazy on either end. But it could be a little bit longer. We do have, well, not only crushing plants, but also renewable diesel facilities that are supposed to open later than 2023. So it will kind of be an ongoing thing, but I would expect that it will kind of, unless renewable diesel demand really starts to overtake the expansion in crushing capacity, I would expect that we'll settle into the equilibrium before both of the expansions are finished. All right, great questions, everybody. Really appreciate it. Thanks, as always, for attending this week's webinar. I hope everybody has a great week, and I hope to see you back here next week. All right, have a great week, everybody. Bye.